So that's kind of the backward looking financial models. And let's just take the last little bit to look at forward. So again, the fledglings have been tasked now with creating a 3-year or 5-year financial model. For some reason in the world of startups, we either do a 3-year or a 5-year. We never do a 2-year or 4-year or 6-year. That's just totally uncommon. You do 3 years if the company looks good at 3 years. So if the company is of a sufficient scale to look profitable, is profitable, and big enough that an investor would potentially invest in it in 3 years, for year 3, then do 3 years. And if after 3 years it still isn't quite hitting that hockey stick curve, then do 5 years. That's the basic rule. So the forward-looking financial models exist to answer a few questions. First and foremost, can this business model make money? Is it ever profitable? How much money are you going to burn getting to that profitability? And so you can do this on the backward ones too, if the company's up and running already. Is it profitable, and how much has it burned in the last year or two trying to get there? How much money can it afford to take in? Can it afford to take in debt? Can it afford to take in equity? Like, how much is it going to have to give away? We'll talk about that another day on how you value that in order to get investors to come in. Basically, if this company was doing, we'll just flip back a second here. If this company was doing 275,000, this is in dollars. If it's doing $275,000, oh, look at that. Sorry, but isn't it strange how it's doing $275,100 per year, every year for 4 years without changing?
Literally incredible.
The numbers above it have changed. Yeah, get spreadsheet errors. So if the company is $275,000 in revenue and they're on the phone with you in a actual real pitch event, a pitch meeting, and they've asked you for $50,000, and they say, with this, we'll be a $500,000 a year company, and they can prove it to you in a financial model, that should sound great. If instead they said, well, last year we did $275,000 and we're raising $500,000, and here's what we're going to do with it, and it's going to make us a $500,000 company, then you should take pause at that and wonder why it's so expensive to get where they're going. So that's what financial modeling is trying to answer. And you can, in fact, do it all on one spreadsheet if you follow that pattern that I created. So this is just showing them what that would look like in spreadsheet form. When we do financial models, we typically do monthly financials for the first year, and then we do quarterly financials for years 2 and 3. And then we iterate the hell out of that until we have numbers that we like. And then we look at that and decide whether we have to do 5 years. And if we can get away with 3, we'll stop at 3. Because trying to predict years 4 and 5 is tough. Trying to predict year 3 is tough. Trying to go past that, you basically just project forward. You're not thinking through how much am I going to spend on travel in year 4 and 5. You're just taking year 3 and you're adding something to it each year. So this is the spreadsheet off of the download with revenues and expenses, net income, and then those capital expenses, investor capital. In this case, there's just 3 lines instead of 5 lines, and net cash, and it's showing you all the formulas. Okay, and that very bottom line, that cash in the bank, is really what's important in the forward-looking financial model. And then what I teach people once they have one of these is how to use that to turn it into the actual versus budget spreadsheet by adding another column and turning your columns that you thought were forward-looking at some point become backward-looking, and you fill in actuals, and then you can iterate on your model again. Financial models are never done. Financial models are just good enough for now, and then as soon as you have real data to plug in, they become wrong. So you put in your actuals, and then what you're supposed to do is spend a little bit of time fixing what the forward numbers are actually going to be given the backward-looking numbers. So if you do this all on this one spreadsheet, then this becomes both backward and forward-looking, and it becomes much more reliable. And then there's some more rants at the very end about pennies and stuff, and commas and net margins, and I'm not going to go through that. I'll just leave that on the screen, and I'll open that up to questions now.